Wait, so how is it that a naval standoff halfway across the world is about to make your condoms like 30% more expensive?
I mean, it really is the ultimate geopolitical butterfly effect, isn't it? The
Yeah.
physical world breaks down, and suddenly the cost of synthetic rubber just skyrockets.
Welcome back to Casutalks, everyone. Your daily deep dive into the absolute chaos of the news cycle.
And we are so glad you're here at the virtual coffee shop with us today.
Yes, grab a drink. Because if you were trying to make sense of how a dense stack of, seemingly unrelated financial reports, Middle East geopolitical updates, and wild crypto market charts all somehow bleed into each other, you are definitely in the right place.
We are looking at a huge data dump from late April 2026 today. And honestly, the mission is just to connect the dots.
Exactly. We're unpacking how a physical choke point in the Middle East is basically ripping right through your grocery bills, forcing the hand of central banks, and in a really massive twist, fueling this absolute explosion in decentralized digital assets.
The contrast is what is truly fascinating here, I think. We're looking at a localized, highly physical conflict that's creating such a severe drag on traditional markets that capital is actively fleeing, like it's migrating into borderless digital infrastructure.
Right.
But to understand that migration, we have to start with the physical reality on the water.
Yeah, let's look at the Strait of Hormuz because, if you read the political headlines right now, they're screaming about a ceasefire. President Trump has indefinitely extended the U.S.-Iran ceasefire, pending some unified Iranian proposal.
Which sounds great on paper.
Right. If you just read the chyrons, you would totally think tensions are cooling. But the economic data tells a completely different story. The strait remains effectively closed.
It is entirely a paper ceasefire, but a very physical blockade. Iran is categorically refusing to negotiate. They're vowing not to reopen the road. And on the other side, the U.S. military is actively maintaining its blockade of Iranian ports. They actually recently seized an Iranian-flagged cargo vessel right in the Gulf of Oman.
Which is a huge deal.
Oh, massive. So regardless of all the diplomatic posturing in Washington or Tehran, the commercial reality is that one of the most critical energy arteries on the planet is just severed.
Cut off. It's like watching a localized traffic jam cause a massive global heart attack, right? And the immediate mechanism of that severed artery is playing out right now in the crude oil markets.
Yeah, the prices are wild.
Brent crude is hovering perilously close to $100 a barrel. But the metric that really caught my eye in these energy reports isn't just the price. It's the sheer volume of demand destruction.
Yes, the VTOL report.
Exactly.
Yeah.
Major oil traders like Vitol, they're tracking roughly 5 million barrels per day of demand destruction globally. 5 million.
Which, if we connect this to the broader macroeconomic picture, demand destruction is a terrifying metric. It is so dramatic. It means the market hasn't found efficiency. It has hit a breaking point.
Right. People aren't just driving less, things are breaking.
Exactly. When energy becomes that prohibitively expensive, industrial capacity physically shuts down. Factories literally cannot afford to run their lines. Logistics companies cannot afford the freight rates.
But just stop.
They just stop.
Right.
At 5 million barrels a day, which is roughly 5% of total global supply, by the way, you are watching a massive segment of global economic activity simply evaporate. Just because the input costs are way too high to sustain operations.
It's a forced economic diet, essentially. And the starvation trickles down to the consumer level instantly. Like, you can see the mechanics of this playing out vividly in the UK right now.
The inflation numbers there are brutal.
Their inflation just spiked back up to 3.2%. And when you isolate the variables driving that, it's just a pure energy shock. Motor fuel saw its highest jump in 3 years. Airfares are up 10% because, jet fuel is a direct derivative.
Right.
But the food inflation is what really highlights the supply chain vulnerability to me. Food inflation is up to 3.7%, with beef prices alone spiking nearly 19%.
Because, and this is the dramatic irony of the modern world, agricultural economics are essentially just energy economics in disguise.
Oh, that's such a good way to put it.
To get that beef to a supermarket, you are paying for the natural gas required to produce the fertilizer, the diesel for the tractors to harvest the feed, the fuel for the transport trucks, and the power grid requirements for all that cold chain refrigeration.
So it's oil all the way down.
Exactly. When crude nears $100, that 19% spike in beef isn't some weird anomaly. It is a direct mathematical consequence of the input costs.
Which brings us to my favorite, albeit slightly absurd data point in this entire stack, the Carex situation.
Uh-huh. Oh, yeah.
So Carex is the world's largest condom producer. They supply the NHS in the UK. They supply massive UN aid programs, commercial brands globally. And they just issued a warning that they are projecting a 30% price hike.
The geopolitical condom index, I love it. I mean, it's brilliant because it perfectly illustrates how deeply petroleum permeates goods you would literally never associate with a barrel of oil.
Exactly. The manufacturing recipe is incredibly petrochemical heavy.
Yeah.
You've got synthetic rubber and nitrile. You have silicone oil for the lubrication. You have aluminum foil for the sterile packaging.
Every single one of those materials is tied to crude oil.
Every single one. And then, because the physical trade routes through the Red Sea and the Strait of Hormuz are just too dangerous right now, the finished product has to be shipped on much longer, much more expensive routes.
Right, around the Cape of Good Hope.
Yeah. It is a textbook example of how a localized naval standoff compounds into a massive markup on a basic consumer health product.
And that compounding effect is absolutely devastating national budgets, too. Let's stick with the UK for a second and look at Chancellor Rachel Reeves.
Oh, her budget headroom.
Yes. So in her autumn budget, she managed to carve out about 21.7 billion pounds in fiscal headroom. It was supposed to be a buffer, right? A safety net.
Right.
Now, the Treasury is warning that this energy-driven inflation could wipe out 75% of that headroom almost overnight.
Wow. That is a staggering evaporation of public capital. Just poof, gone. And that happens mechanically because government debt is so heavily exposed to inflation, right? When inflation spikes, the yields on government bonds surge because investors demand higher returns to offset the eroding purchasing power.
Precisely. The cost of servicing the national debt just skyrockets. Furthermore, state pensions and various welfare payments are often legally indexed to inflation.
So they have to pay more.
Right. So as the cost of motor fuel and beef surges, the government's mandatory payouts increase automatically. It is a vicious cycle where the physical conflict drains the digital spreadsheet of a sovereign treasury in real time.
It's wild. If you think about the Strait of Hormuz as the global economy's carotid artery, it's essentially starving the global supply chain while simultaneously inflating the cost of whatever actually manages to trickle through.
You lose-lose.
It really is. But what I find truly perplexing, honestly, is how unevenly this is hitting the global economy. Europe and the UK are clearly buckling under the strain. But then you look at the United States, and the data paints this incredible economic paradox.
The U.S. resilience is the massive outlier in this current macroeconomic landscape. It's almost dramatic how different it is. Despite all the global inflation fears and the energy shock, the U.S. consumer is continuing to spend aggressively. March, retail sales jumped 1.7%, completely blowing past the 1.4% forecast.
Now, to be fair to the data, a huge driver of that top-line number was a 15.5% spike at gas stations. Since gas prices are up due to the oil shock, consumer spending at the pump naturally inflates the overall retail figure.
Right, forced spending.
Exactly. But you cannot dismiss the underlying strength because core retail sales, which strip out those volatile energy and food prices, they still jumped 0.7%, crushing the 0.2% forecast. Add in the ADP data showing private employers adding nearly 55,000 jobs a week, and you have an economy that is running incredibly hot.
And this robust domestic data is setting up a monumental clash for monetary policy. Because the person stepping into the arena to manage this is Kevin Warsh.
The Fed chair nominee.
Yes, he's currently navigating his Senate confirmation hearings. And Warsh is bringing a fiercely traditionalist, hawkish ideology to the table.
His testimony was fascinating to read. I mean, he made this incredibly blunt statement. He said, inflation is a choice. That is not the kind of soft, data-dependent, wishy-washy language we are used to hearing from central bankers. It is a direct ideological line in the sand.
It is a profound statement of intent. Warsh is signaling that he believes the Federal Reserve has historically been too accommodative and, frankly, too slow to react. Mechanically, he is advocating for a much smaller Fed balance sheet. He explicitly stated the Fed should avoid holding long-term treasuries,
which fundamentally changes the monetary transmission mechanism. By refusing to hold long-dated treasuries, Warsh is stepping away from the tool that suppresses long-term interest rates. He's effectively saying the Fed should not be in the business of subsidizing long-term corporate borrowing or mortgages. He wants the free market to price that risk, which inevitably means higher borrowing costs for businesses trying to expand.
And that is exactly the friction point. During the hearings, he fiercely defended the Fed's independence. He publicly pushed back on reports that President Trump was pressuring him to commit to rate cuts.
He wants to be the adult in the room.
Exactly. He wants to be the one who takes away the punch bowl. He is advocating for quantitative tightening in a world that is desperate for liquidity.
But okay, let's unpack this, because this is where I really struggle with Warsh's positioning. He claims there is a short, critical window to bring down inflation. But as we just discussed, the U.S. economy is adding jobs, and core retail sales are booming.
The demand is there.
Yeah, the domestic economy is inherently inflationary right now. So if he aggressively shrinks the balance sheet and pushes yields higher to fight the oil-driven inflation from the Middle East, isn't he applying a blunt domestic hammer to a complex international supply chain problem? Like, if you squeeze capital that tightly, you don't just cool inflation, you risk fracturing a really resilient labor market.
It is the classic central banking dilemma, just amplified by geopolitics. Monetary policy cannot drill for more oil, and it certainly cannot reopen the Strait of Hormuz. All Warsh can do is destroy domestic demand to match the restricted global supply.
Which is brutal.
It is. And to your point about his traditionalist approach, he is equally rigid regarding financial innovation. During the hearing, he flatly stated that the Fed lacks the legal authority to issue a central bank digital currency, a CBDC, and he argued vehemently against even pursuing one.
See, and that firm rejection of a sovereign U.S. digital currency is the perfect catalyst to look at what is happening in the private sector. Because while traditional financial architecture is struggling under the weight of geopolitical blockades and restrictive monetary policy, the decentralized digital markets are experiencing an absolute renaissance right now.
The divergence between traditional equities and crypto right now is stark. I mean, you have major tech pillars like Apple sliding 2.5%, pulling the S&P 500 down with it, largely because equities are highly sensitive to these geopolitical risks and the threat of a hawkish Kevin Warsh.
Sure.
But simultaneously, Bitcoin is shattering 11-week highs, surging past $78,000. The total crypto market cap has swollen to $2.61 trillion.
Trillion. The sentiment shift is just violent. The fear and greed index for crypto was sitting at a dismal score of 8, which is like extreme fear just weeks ago at the start of April. It has rapidly rebounded to 33. But what makes this rally critical to understand is that the underlying mechanics are structurally different from previous cycles.
It's not just hype.
Exactly. This is not a retail-driven meme rally. This is institutional plumbing working at scale.
The volume tells the story here. We are seeing massive ETF inflows, $1.8 billion, flooding into funds like IBIT and ETHA over just 3 weeks. The institutional accumulation is so aggressive that a prominent strategy firm actually surpassed BlackRock to become the largest institutional holder of Bitcoin.
Wow.
BlackRock.
Yeah. The big money is treating this as a legitimate haven from physical supply chain fragility.
And those institutional inflows are triggering massive volatility mechanics on the trading side, particularly with these severe short squeezes. Because when you have an environment where traditional macro indicators suggest caution, a lot of institutional traders inevitably bet against digital assets.
Right, they open short positions.
Exactly. But when billions in ETF capital suddenly flood the spot market, the price spikes and those bearish positions are liquidated. The mechanics of a short squeeze in this high liquidity environment become a self-fulfilling prophecy. It forcibly drove Bitcoin through that $75,000 resistance level. And what is arguably more impressive than the Bitcoin surge is how the broader crypto ecosystem is absorbing massive liquidity events. Like, we are looking at significant token unlocks for projects like SUI, ZRO, and HYPE.
Which is usually a highly bearish event. For anyone tracking tokenomics, a token unlock basically means previously frozen assets, often held by early investors or developers, are finally released into the circulating supply.
Right.
The disclosed amounts for these specific unlocks exceed $540 million. Basic supply and demand mechanics dictate that when you suddenly dump $500 million of new supply into the open market, the price should plummet.
But it didn't. The market is absorbing it. The buy-side liquidity is so deep right now that it is swallowing these massive supply dumps without breaking the overarching bullish trend. It is a massive indicator of structural market strength. And that strength is forcing the hand of global regulators to finally build out the legal architecture for these assets.
Yes, the regulatory scramble. In the U.S., the draft of the Clarity Act is moving forward, though it's facing some heavy friction. Senator Tom Tillis noted that disagreements over stablecoin staking are likely going to delay the framework until at least May.
The stablecoin staking debate is fascinating because it is fundamentally a fight over yield.
Always about the money.
Exactly. If a stablecoin issuer is holding billions of dollars in traditional treasury bills to back their digital tokens, those treasuries are generating significant interest. The debate is over who gets that yield. Does the issuer keep it? Do they pass it on to the token holder?
Right.
And if they pass it on, does that mechanically transform the stablecoin into an unregistered security? It is a massive turf war between traditional banking regulators and crypto innovators over the foundational plumbing of digital dollars.
But while the US is bogged down in jurisdictional turf wars, Europe is aggressively laying down the infrastructure. You have a consortium of 12 major European banks, led by Quavalis, officially selecting Fireblocks to launch a Euro-pegged stablecoin. They're building this strictly in accordance with the new European regulations.
They're moving fast.
Yeah. Meanwhile, the UK is formally reforming its payment sector to integrate tokenized deposits directly into the traditional banking system.
Because the institutional buy-in is global now. You have research from major consulting firms like Accenture tracking how artificial intelligence and blockchain integration are shifting the employment landscape. You have massive capital formation happening at events like Paris Blockchain Week. The legacy financial system is conceding that tokenized architecture is just vastly superior for moving capital quickly and cheaply.
But okay, if we zoom out and synthesize this geopolitical standoff with this crypto surge, we hit the most profound data point in this entire stack. While the West builds stablecoins for banking efficiency, other sovereign nations are weaponizing the architecture out of pure necessity. Let's look at what is happening in Russia.
The Russian State Duma just passed a bill in its first reading that officially legalizes the use of cryptocurrency for foreign trade settlements.
Now, the hypocrisy here is brilliant because Russia strictly prohibits the use of cryptocurrency for domestic payments. The ruble is fiercely protected as the only legal tender inside their borders. You absolutely cannot walk into a cafe in Moscow and pay for a coffee with Bitcoin.
Exactly. But Kaplan Panesh, a deputy chairman of the Duma, made it explicitly clear that this new legislation is a targeted carve-out for international trade. Because Russia is heavily sanctioned and largely cut off from the SWIFT banking system, their physical exports and imports are incredibly difficult to settle financially. Traditional correspondent banking is blocked.
So they are using the decentralized ledger as a geopolitical bypass. Russian companies can now legally settle multi-million-dollar cross-border transactions using digital assets, entirely outside the purview of the US dollar dominance or European banking sanctions.
It is the ultimate utility of a decentralized network. The network does not know or care about global sanctions, It only verifies that the cryptographic keys match.
Right.
By officially sanctioning this at the state level, Russia is validating the thesis that cryptocurrency functions as an uncensorable settlement layer for sovereign states.
But then, on the other hand, you have the digital world reacting. While physical trade routes are barricaded, you have nations building completely invisible digital trade routes to bypass traditional financial blockades. Crypto is no longer just a speculative casino. In a fractured geopolitical landscape, it has become the new, unblockable high seas.
It really raises a profound macroeconomic question about where we are heading. We are watching the friction of the physical world rapidly accelerate the adoption of borderless digital infrastructure. As physical supply chains become more contested, more expensive, and more fragile, capital is going to continuously seek the path of least resistance.
Which leaves us with a truly fascinating thought to chew on as we wrap up today. If localized wars, seized ships, and blocked straits are going to make physical inflation a permanent fixture of our reality, will we see a complete divergence in how wealth is stored?
That is a million-dollar question.
Right. Are we moving toward a future where physical goods are essentially trapped as expensive, localized luxuries?
Yeah.
While capital completely detaches from the physical realm, living exclusively in a borderless digital ether. I mean, in a world where physical borders are closing, a purely digital asset class might stop being a speculative luxury and become a fundamental necessity.
It is a phenomenal question. When the physical supply chain breaks, the digital ledger might literally be the only reliable infrastructure left.
That is definitely something to keep you up at night. Well, that brings us to the end of today's deep dive here on Casutalks. We want to thank you so much for hanging out, drinking some coffee with us, and exploring how a naval standoff connects to the Federal Reserve, Bitcoin short squeezes, and yes, the price of your condoms.
We always love untangling these chaotic headlines with you. Keep questioning the connections, and whatever you do, don't take the traditional narratives at face value.
Make sure you come back tomorrow for more deep dives into the news cycle.
Please like, share, and don't forget to jump into the comments and drop today's funny phrase type, geopolitical condom, in the comments. See you next time.